Today we're going to take you through an income statement. We're going to let you know what is an income statement, and there are a couple of other names that are associated with it, but we're going to stick with income statement first of all, what it is, why we use it, and what does it show us. I am Prof. It. Yes, you heard right. Prof. It. Profit. And I'm going to take you through all these financial statements and show you what it is. So let's start off with looking at the actual income statement. So what does it do? It summarizes a company's revenues. Okay, revenues is the sales or the income that it gets in, and it looks at expenses over a certain reporting period. In different parts of the world, they've got different names, and it's different parts of the world and at different stages. So it used to be called the P&L or profit and loss statement, also known as statement of earnings, statement of operations, or statement of income. This is really your basic income statement. It starts off with sales. Less cost of sales gives you gross profit. Less expenses gives you your net income. Now, when we say you take this, less this, gives you this. Your sales is when you make a sale, the money that you get in for it. The cost of sales is the cost directly associated to that product. So if I'm selling bottled water and I'm selling the bottled water, the total of all the bottled water I bought for $100, but the bottled water actually cost me $60, that's my cost of sales. I'm left with a gross profit of $40. But in order to sell this, I need to pay for advertising and marketing, rent, etc. All those things are seen as expenses, and we take that out and we're left with your net income. In fact, my sales are 100, my total costs are 90, but I split it out. And we split it out so that we can analyze the business. That's the reason for splitting it out. If I look at a sample income statement, I've got here the income statement for the year ended. Very, very important to have a look and say, to see that it's this, the way it's worded, for the year ended. It's for the entire year that we're looking at. You've got your sales, less your cost of sales gives you your gross profit, less all your expenses. And there you've got your operating expenses, is rental, advertising, commission, etc., etc., etc. What I'd like you to see is that it's in a block. And on top of the block, your operating expenses totals 36,150. That's made up of all the numbers underneath it. And you're left with EBIT, which is earnings before interest and tax. Some people think it's earnings before income tax. It's not. It's earnings before interest and tax. We then take off your interest and you're left with your earnings before tax. Take off tax and you're left with your earnings after tax. So you've got a very simple income statement. Just says, what are my sales? What are all my costs? Gives me my profit. I'll break those costs into direct cost, which is your cost of sales, and indirect, your advertising. We break it down now even further, and you can break it, and that's down into the different levels, and that's what your income statement does. And that's why sometimes it looks more complicated, because we're breaking it into all these different elements. Really, this is a diagram of the income statement. You've got sales, less cost of sales gives me my gross profit. I'm taking the sales less the blue bit, leaves me with gross profit. I take the rest of the blue bit, which is all my expenses, gives me operating profit, less interest, less tax. I'm left with profit after tax. That belongs to the shareholder. We take that money and we pay it either directly to shareholders in the form of a dividend, and what we don't pay out is called retained earnings, and we keep that in the business. Now, I am going to talk a lot more around this and explain dividends and retained earnings and link it to the balance sheet or the statement of financial position, but we're going to do that in a later lecture. Just to show you an actual income statement. So here you've got the consolidated statement of operations. Remember, I told you another name for income statement is statement of operations. Consolidated just means they've taken all the different aspects of the business and put it into one. This is obviously of Apple, and as you can see, you've got net sales less cost of sales gives you your gross margin. We sometimes call gross profit, sometimes call gross margin. And if we're looking at September the 27th, 2014, you can see that they made a gross margin of 70 million. And then it's less their operating expenses, which is research and development, sales, general and admin. That whole block is added up to be the 18. You're left with the operating income. And then we have other income. Now, the other income is other things that are not directly related to the actual business, and that gives you your income before tax. Then take off your tax and you're left with your net income. And you can see that in 2012 it was 41 million, 13 it was 37 million, 2014 it's 39.5. We take those numbers and now we start analyzing even those numbers. So you take something called your earnings per share. You take the number of shares and you divide that income by the number of shares. And if you owned a share in Apple in 2014, you would have earned basically $6.50 per share. And we talk about basic and undiluted. Those type of things we're going to talk about in a future lecture. Hope you've enjoyed this lecture from Prof. IT, and I'll be back.